This story came out on Bloomberg a few days ago. It is about a top bond fund manager bracing for emerging market sovereign defaults in 2020. So this guy's name is Dan Shaykevich. Hopefully I pronounced that all right. Co-head of emerging market and sovereign debt at Vanguard, which is a very large money manager. Most of their assets under management are index funds, but I think they also have some actively managed products. And this guy is a very good fund manager, apparently, for emerging market sovereign debt. He outperformed 99% of his peers during the last 3 years. So he's pretty good at what he does. And he is saying in this Bloomberg piece from January 2nd by, let's see here, Sydney Maki, that he expects 2020, quote, "We think 2020 will be much more about avoiding the losers. You are going to have a year where there will likely be defaults in emerging markets." So he is still bullish some emerging markets, but he thinks that there's going to be a lot of emerging markets with a lot of problems. And again, this circles around back to the dollar and the dollar tug of war and the amount of dollar denominated debt and the amount of dollar liabilities off balance sheet, these forward dollar swaps and other problems. And the problem is so large that in an interview from Pedro da Costa on December 12th, a former Fed economist that works for a hedge fund, his name's Roberto Perli, now a partner at Cornerstone Macro, and this ties in with repo. So repo madness, there's so many problems associated with repo. One of the problems about repo and with the dollar and dollar denominated debt and forward dollar swaps that the Bank of International Settlements talked about in their quarterly December report. One of the major problems, and it was highlighted in this podcast from Macro Musings by Josh Galper was the guest, Galper. I'll put a link to it in the information and description section. It's about an hour if you want to listen. And he talks about this foreign reverse repo facility that the Federal Reserve has had for years, and they knowingly allowed foreign central banks to start pulling out reserves. So they were earning interest there, and then also they were pulling reserves out of the U.S. and draining the U.S. of liquidity and reserves and bringing them dollars and bringing dollars to emerging markets to put out fires there and help in emerging markets. So that has been going on for a while. Plus, foreign central banks were earning interest at the expense of American retirees and American savers. So that has been going on since the 2008 financial crisis and all the gobbledygook that policies and lever pulling that the Federal Reserve installed. So the Fed created a bunch of other problems that up until the repo madness became public, most people were not aware of. And one of the problems was this foreign central bank reverse repo facility. So you had the Federal Reserve, which was with quantitative tightening, which was reducing the money supply and also pulling reserves out of the system, reducing the amount of reserves in the system. I think at one point there was over 2 trillion in reserves, 2.6 trillion, and then I think it got halved down to 1.3, and then you have the large money center banks, which make up a large portion of the primary dealers. There's 24 primary dealers, but the large U.S. banks, they are the main parts of the primary dealers. There's also smaller Wall Street investment banks and trading houses, which really can't afford to buy their treasuries now, and they're going into the repo market to use the repo borrowing to go and buy treasuries for that as well. At least they have for the last, 3 or 4 months, at least, probably longer than that. But the larger banks also pulled reserves out of the system. So you had quantitative tightening, which was reducing the money supply. The Fed's balance sheet was contracting, and they were reducing the money supply, and the reserves in the system were being drained, not only by quantitative tightening, not only by the large banks, the large banks were using their reserves to buy treasuries. So JP Morgan, it came out, had increased the amount of the U.S. treasuries they owned by 50% in only 12 months, which is a very large amount increase. And then also you had reserves being drained from this foreign central bank reverse repo facility. And so that's what culminated, at least some of the problems that culminated with repo madness. And this brings me back to the dollar. So the dollar is my thesis is, for the last couple years, the dollar has been in a very powerful tug of war. two very strong forces pulling on the dollar, and this is why President Trump, the Trump administration, the U.S. Treasury, the Federal Reserve, they can't get the weaker dollar they want. They want to devalue the dollar fast enough, as if the dollar hasn't already been devalued a lot already. They want to devalue it faster, and the demand for dollars globally is enormous. That's the other thing pulling on the dollar. I pulled estimates from the Bank of International Settlements, from their research and elsewhere, and what I come up with is around at least $24 trillion in dollar demand, dollar liabilities globally for dollar-denominated debt where the payments must be made or default occurs immediately, like what has been happening now in China and emerging markets with defaults on dollar bonds, and also those off-balance sheet dollar liabilities, which Claudio Borio said in an interview on Bloomberg were larger than the total amount of dollar-denominated debt. And he did not seem very confident that, I think he said 13 trillion on that Bloomberg interview. He did not seem very confident. When I was listening to him talk about that number, he didn't seem very confident that it was only 13 trillion in off-balance sheet forward dollar swaps, dollar liability. So that's absolutely massive, and that creates demand for dollars. So you have those two forces pulling on each other. It's kind of ridiculous how the U.S. government wants the dollar devalued even faster, but it is what it is. But they can't get the dollar weak enough, despite all the crazy stuff that's being done. Brent Johnson talked about this on Macro Voices today. Shout out to Brent. He's a friend of mine. He did mention the dollar tug of war, but he didn't name me specifically with coming up with the thesis. So that's why, in spite of all the craziness the Fed has done, the amount of Treasury borrowing that the Fed has had to do in the last 7 or 8 months, that's why the dollar has not gotten super weak. I mean, on the dollar index is still, let's see here, dollar index is still at 96.69. It's only down 0.15% today, in spite of all the craziness, the geopolitical stuff with gold and oil prices rallying. There was a big pop last night in gold, and oil prices are up strong. So my main point here with this dollar tug of war, there's two powerful forces pulling different directions against the dollar, and this tug of war is so both teams are strong, so the dollar is not really moving that much. But it's a lot more complicated than just saying the dollar is going to collapse, the dollar is going to be devalued massively, the Fed's going to immediately be able to devalue the dollar 10, 20, 30, 40%. It's a lot more complicated than just that. So Lynn Alden on the Jelly Donut podcast, I've talked about this interview before. It was a couple weeks ago on December 20th. Shout out to Lynn Alden if she listens to this podcast. I know she's watched a few of my videos lately. And also Ryan from the Jelly Donut podcast. It's a new podcast, and I know he listens to the show because I was just talking with him earlier today. And she gives a great interview there, and she's talking about her thesis for why the dollar is going to get weaker in the near term. And yes, the dollar index has gone down, but the trade-weighted dollar index, which is something the Fed also looks at, I mean, they created the trade-weighted dollar index, and that's a basket of over 26 currencies, and that's more dollar versus emerging markets. Brent Johnson was talking about this today in his short little Macro Voices interview. I'll try to put that, I saw it on YouTube, so I'll try to put that attached at the end of this video, in the last 20 or 30 seconds of the video, if you want to listen to that too. And he said he was talking about all the different dollar indexes, and the dollar has not moved a whole bunch. So in spite of all the craziness one way or another, the dollar is fairly stagnant, it's fairly range bound, and I suspect, my educated guess is this will continue. I actually agree with a lot of the arguments on both sides of the weaker dollar, that the dollar should be weaker, and also the demand for dollars. I think there's merit to both. But the evidence, the real world evidence, is that in spite of all this stuff, a lot of these two forces pulling on each other have been negated, at least for a while. And that's why it fits with the analogy of a tug of war, because you have two very powerful forces pulling on the dollar, and it's not moving the dollar really one way or another. The trade-weighted dollar index, to me, it's at 129.1496. Let me just pull up a chart. I have the chart here. It looks like it's in a little of a correction, but I mean, it's not in a clear downtrend yet. For it to be in a clear downtrend, it really has to go below 127.59 from July 17th or below. It touched this resistance level a couple times, 126.26 from February 6, 2019, and right around there, a little bit below on January 16th, 2019. So it's got to either get below 127, that exact amount that I just named, or right below 126 for the trade-weighted dollar index to be in a clear downtrend. I mean, it's having a little correction now, but I don't see any evidence that the dollar is about to massively weaken, at least not yet. One of those main reasons why the dollar won't massively weaken is because the dollar index is made up so much of the euro, and there's so many problems with the euro. Also, because we have a lot of the same mistakes from the 1920s and 30s being repeated with currency wars and trade wars. And they're trying to, the European Central Bank and the European politicians, the technocrats in Brussels and elsewhere, are trying to weaken the euro. So they don't want a strong euro. They're trying to weaken the euro against the dollar to boost their exports. And this is why President Trump, because the US cannot devalue the dollar against the euro. Trust me, the Federal Reserve, the Treasury Department, they are looking at the dollar index. They are looking at the trade-weighted dollar, of course. The trade-weighted dollar matters enormously to the Fed. So even if they get one of these indexes weaker, the other one might not. So this is a complicated problem where the Fed is looking at both of these things and they're trying to figure out how they can get the dollar down. And the euro, like I said, is trying to weaken itself, devalue against the dollar. And this is why Trump, because they can't weaken the dollar fast enough, and there's other reasons for this, obviously. Trump does want to protect American workers, and he does view protectionism as a way to protect American workers and American jobs. But the other major reason that Trump is telling Bob Lighthizer to start putting more tariffs on European goods is because they can't devalue the dollar and the dollar index. They want it down, in my opinion. But they can't get it down where they want to get it because the European Central Bank has expanded its balance sheet massively. They're buying up bonds like crazy. Clearly, the European Central Bank is in a massive money printing, asset buying, devaluation mode. So the US, because they cannot get the dollar down against the euro, that's why Trump has ordered Lighthizer to start planning to increase more tariffs against the European Union. That's one of the major reasons, in my opinion. So this is where all of this stuff connects. And this is why I talked about, with my dollar thesis tug of war video a few days ago, why I think the dollar will be one of the most, if not the most, important stories of 2020. Muddy River says the U.S. is parasiting the rest of the world. The U.S. gets free stuff for dollars. It's not as simple as that. So the world reserve currency, there's actually a lot of people who don't want the world reserve currency. It's not quite as simple as that. But yes, the U.S. does not have to produce as much. The U.S. still produces a lot. There's also a lot of waste, too. The world reserve currency is actually considered a curse by many. And you have to run trade deficits with the world reserve currency. We're on a dollar standard, too. What we're on is a dollar standard 2 now, so everyone needs dollars for the system. And this is why you have, again, back to this, I think this is a really important interview from December 12th, the Forbes interview. Fed officials are stressed out about ongoing disruptions in bank funding markets. So this interview was from December 12th. Pedro da Costa, who was a Fed insider before I think he lost his job at the Wall Street Journal because he asked Bernanke or Janet Yellen, one of the two, I think Janet Yellen, a question she didn't like. So they told him that they didn't fire him, but I think they told him basically that he wasn't getting his media pass or press pass back to any of the Fed conferences, any of the Fed press conferences to ask questions anymore, that he was having his press conference, his credentials revoked there. So let me talk about what Perlet said. The state of the repo market continues to remain front and center of many discussions among investors. Perlet said the concern is that as year-end approaches, so the Fed has gotten past year-end for now, so they've managed to buy at least a week or two on the repo problems. We'll see what happens in the next couple weeks and months to come. I do not think there is a long-term solution for repo yet. So I think in the next couple weeks or the next couple months, I think repo is going to rear its ugly head because a lot of the things I just discussed earlier in the show are still connected to repo. A lot of those different entities that got in trouble, they panicked and went to the repo to borrow, to to delay bankruptcies or other problems. So, back to the quote here from Perley. The Fed would again lose control of repo rates, causing dangerous ripple effects across other markets. Perley says the Fed's intervention starting in September have been successful, but adds there is, quote, no guarantee that this will continue to work, since at year end these strains in the repo market are likely to be exacerbated. So they threw so much money and credit in the last couple weeks that a lot of these problems for now were papered over, but a couple weeks or a couple months from now, this could change. And there are other repo experts. Well, I'm not a super hardcore repo expert. I haven't been in that market trading it for years, but as I've been just following a lot of the experts' work now for 5 or 6 months. Zoltan Posner, he has been saying that in spite of all this, the Fed, within like 2 or 3 days after they read his newsletter in mid-December, they then increased the amount of liquidity offering for the end of the year. So they were able to read his newsletter that came out. He writes for, I think, Credit Suisse. He's a sell-side guy, so he's not allowed to have a Twitter. At least that's what Danielle DiMartino Booth told me when I asked her why he didn't have a Twitter, because a lot of people would be following him on Twitter now. And what he is saying is that even though they papered over everything with even more emergency liquidity in the last couple weeks, since the Fed changed their policies again in mid-December after they read his newsletter and prepared for massive amounts of extra liquidity at the end of the year, that this has not fixed anything, and that there will be QE4 I think he thinks in the next month or two. So let me just go back to this Forbes article. Perley cited a number of additional tools at the central bank's disposal that should prevent any hiccups in repo from having broader effects on credit markets or interbank lending. Quote, first, it can do more of the same and inject more cash, he said. So this is the Federal Reserve just issuing more press releases about more emergency liquidity injections with new repos every couple weeks, which is what the Fed was doing every 2 or 3 weeks, starting once Repo Madness became public on September 6th, late night September 16th, and then on all the press releases came out September 17th. So second, and this is what he said here, second, it can encourage, I think this fits in with today's topic more about the dollar problems with emerging markets, with dollar-denominated debt, and the off-balance sheet forward dollar swap, dollar liability problem, which is also connected to repo and also connected to the foreign central bank reverse repo facility. Second, it can encourage the utilization of its currency swap agreement with foreign central banks. And third, so there we go, currency. He said that the Fed should start to ramp up the central bank currency swap agreements, which would flood these emerging market central banks or other foreign central banks with more dollars. So this foreign central bank reverse repo facility, which was connected obviously to the Fed and connected to Repo Madness, also connected to dollar problems and too much dollar denominated debt. And these foreign central banks have been draining the US. In addition to quantitative tightening, they were taking liquidity and reserves out for themselves to delay collapse in emerging markets. And I believe that was said on the podcast for Macro Musings with Josh Galper on the current state of repo markets, key bottlenecks, and a balanced proposal to restore stability. That was released. I don't have the exact date on here, but it's from the Macro Musings podcast. I'll put the link in the December 23rd. It was released. Put the link in the information description section. There's also an interesting interview from George Selgin, also on Macro Musings, from December 16th on repo market stress, Fed balance sheet volatility, and a standing repo facility, and how the standing repo facility for the Fed can actually make things worse. The standing repo facility could be like a Fannie or Freddie and make things even worse than that. Even worse than a Fannie or Freddie. Put enormous moral hazard in the system, because then hedge funds will leverage up on these trades even more. They'll leverage up on treasuries. So they'll go 10x or more borrowing and then bet that the permanent repo facility will bail them out. Or leverage on other bets, maybe leverage loans or collateralized loan obligations or mortgage-backed securities. Okay, got a couple super chats here. The Commodore, thank you for the super chat. I agree that there is a dollar shortage. I just think the Fed will create so many dollars under repo and QE that tree world will be flush with dollars. Thoughts? It may take some more time for this to play out. So I think this dollar tug-of-war thesis, the dollar tug-of-war has been going on for a couple years. The dollar index has been range-bound. Really what is broken out, though, is the trade-weighted dollar index. So if you want to get a better picture of the dollar, you can't just watch the dollar index. So I think Lynn Alden is very smart, and I agree with a lot of her thesis. However, she's only looking at the dollar index, and that's where things go wrong for her. So she may be right that the dollar index may continue to correct a little bit more, but she's not adding into her equation analysis of the trade-weighted dollar, because the trade-weighted dollar, in my opinion, is telling a very different story than the regular dollar index. And this is where things get really confusing, because if you're the Federal Reserve and you want a weaker dollar, you can't just look at the dollar index. You're also looking at the trade-weighted dollar, and we know the Federal Reserve loves the trade-weighted dollar because they created it. There was no trade-weighted dollar index before the Federal Reserve created it. Oh, thank you, John Meyer, for the super chat. 10 euros. Much appreciated. So, yes, I think the Commodore, you have to watch the Fed's balance sheet. So right now, the Fed's balance sheet is not as big as the Bank of Japan's or the European Central Banks. Once the Fed's balance sheet gets to, my opinion, maybe that 4.5 trillion level or larger, then I think people will really start to worry. Another good point that Lynn Alden talks about, and I really agree with her on this, it's very smart. I don't think I've heard another analyst talk about this, is balance sheet, central bank balance sheet to GDP ratio. So the U.S.'s, the Federal Reserve's balance sheet to the U.S.'s GDP ratio is still lower. I don't remember the exact number offhand, but it's lower than the ECB's balance sheet to European Union GDP ratio and the Bank of Japan's balance sheet to Japan's GDP ratio. So people are monitoring that. So props to Lynn, shout out to her. But it's a lot more complicated picture than just looking at the dollar index and saying that the dollar index is going to go down a lot, 10, 20%, or it's going to be permanently in a downtrend. Because on the other side of that, you have Raoul Pal, you have Shy Girl, you have Brent Johnson, you have a lot of smart people that are looking at trade-weighted dollar, and the trade-weighted dollar is telling a different story right now than the dollar index. And when you add these things up and you try to balance them as an analyst, I think that's why we get the dollar tug-of-war. Because there's a lot of demand for dollars globally. Otherwise, these foreign central banks would not have been in the foreign central bank reverse repo facility that the Federal Reserve created. So these foreign central banks, and this is ridiculous. I can't believe the Federal Reserve did this. This is why we need not only the Fed audited, but eventually, hopefully, central banks are ending. I don't think it's going to happen in my lifetime. Too many Americans don't care. They don't even know what the Fed is. If you ask like 1,000 people on the street, Americans on the street, they wouldn't be able to give you an answer of who the Fed chairman is. Or if you said who is Jerome Powell, they wouldn't be able to give you an accurate answer. They don't know what the Fed is. But the Fed has been, with this foreign central bank reverse repo facility, they've been giving these foreign central banks fat profits and also giving them a lot of extra liquidity that they should not have gotten. And maybe the Fed thinks that it's benefiting the U.S. economy and the U.S. taxpayer by not having emerging market governments collapse immediately. Because why are these foreign central banks borrowing so much from the Federal Reserve Federal Reserve Foreign Central Bank reverse repo facility? Yeah, initially when I turned on this live stream show, the YouTube counter did say 0 for the first couple minutes. So there was a big glitch last night, 20 minutes in, and it said 0 people are watching despite all the comments in the live chat. So I think it was definitely censorship. I took a screenshot for those of you who don't believe me. It's on my Twitter and in the Wall Street for Mean Street Facebook group. But I'm now under 300 new subscribers on my YouTube channel needed for 30,000. So we're almost to 30,000 in spite of it all. And also the Patreon. In the last week or so, about 20 people, their credit card and debit card companies canceled their Patreon, or their credit card number needs to be updated. So if you guys want to check to see if you're still a Patreon account contributor, there's a lot of new content in there. I put, there's 2 new audio podcasts that have been added there in the last week, and I also put the written article analyzing the Kirkland Lake gold deal with the Detour gold deal. But I think 2020 is going to be a good year for me. I'm very optimistic. This is the most optimistic I've been about building my channel and my business in many, many years. I think I've got good momentum. Hey, heck, people are using my work like Repo Madness all over financial media. Bloomberg, CNBC, Real Vision TV, all using Repo Madness now, although I'm not getting paid for it. But whatever. And I'm sure Dollar Tug of War will now be used a lot too. So there's a very complicated situation going on with the dollar. I think eventually the Federal Reserve will win. I just don't think it's going to happen in the short term. Commodore, I'm not saying dollar would go higher or lower right now. I think it's in a trading range. I think ultimately the Federal Reserve will win because there's games they can play. They could always do a Plaza Accord type agreement and devalue the dollar massively. In the Plaza Accord, I think it was 1980, the Plaza Accord, they devalued the dollar 50%. But that was because Japan and Germany wanted the dollar devalued and they had too much dollar-denominated debt. And the U.S. got beneficial trade agreements in exchange for devaluing the dollar. I believe the Ronald Reagan administration was able to get a lot of investment from Japan and Germany into the U.S., and a lot of factories came back. So I think there were tariff walls here in the U.S., and I think Toyota agreed to build a bunch of new factories here in the U.S. Oh, another super chat. Thank you, Commodore. I appreciate it. You're welcome. You got a reply. Yeah, so I'm not making, full disclosure, I'm not making any bets on the dollar. I'm hedged with gold and gold stocks and silver. So there's very smart people on both sides of the dollar trade who think the dollar is going to be rapidly devalued soon, like Lynn Alden and Luke Groman and others. And then there's people that the dollar is going to have a rip your face off rally. And I'm just saying that this tug of war there's 2 very powerful forces going on, and they kind of negate each other, at least for a while. It could go on maybe another 6 or 12 months. But as the Fed's balance sheet increases and maybe the yield curve inverts again, or there's more total amounts of negative yielding debt, that will help gold. But I could see a scenario where the dollar and gold both rise. That has happened in the past. Well, if you bet one way or another on the dollar, the Fed could, or Treasury Department, the Federal Reserve or Treasury Department could just change the rules. I mean, President Trump has made things very clear on his Twitter what he wants with the dollar. He frequently tweets that the dollar is too high, and they use tariffs as retaliatory against other countries because they can't devalue the dollar. Well, I think there's going to be rules changes. This is what governments do when they don't get their way. So at some point, the Federal Reserve and the Treasury will change the game, change the rules. If the Fed starts pumping out these currency swaps, massive amounts of them, we don't know the real number. There's no audit. If the Fed starts pumping out massive amounts of currency swaps, we're talking like hundreds of billions or trillions in currency swaps, and those dollars start being used to buy assets or other things, then the dollar probably will get devalued. Do I think there will be a war with Iran? It's too early to tell. We have to see what Iran does with retaliation. Trump has promised that he will escalate things. I mean, Iran's been funding terrorism and fighting proxy wars for a long time in the Middle East, so it's tough to tell. It depends what type of retaliation Iran does. So as of now, I would say probably not yet. No war yet. We'll see, though. I mean, if what Iran does is really bad, I mean, Trump will overreact and then probably put us into a war. Okay, well, I wanted to keep the show fairly shorter. Fairly shorter than usual. Let me see if I got everything covered that I want on all my notes. Okay, I tied in that interview with Roberto Perli from 3 weeks ago. Very important, the Forbes one, because he tipped his hand on what the Fed can actually do to deal with the dollar, to deal with repo. So I think that's the most important interview I've seen come out that no one else is talking about. Yeah, I don't want to get into a geopolitical discussion. I just want to talk about markets and the dollar and gold and silver and oil. It's just easier to talk about things like that rather than geopolitical stuff. Also, I'll talk about this on another show. I am working on the China slide deck. I have a lot of the slides done for all the different types of bailouts that China's been doing since May 2019. There's a lot of different ones. It's freaking nuts. There's so many different types of ones that she just hired 12 bailout czars. They have 12 bailout czars now. They have so many different types of bailouts that it's confusing even for them. Yeah, the Fed really wants to devalue the dollar. It's not working. They want it. Well, I mean, the dollar's already been devalued a lot, but they want to devalue it even more. You have people, either former Federal Reserve economists or current Federal Reserve economists talking about a 4% targeting inflation rate. So right now, the official inflation target is 2% per year. There's people inside the Fed and former Fed economists who want a 4% inflation target. So they want to double the inflation rate. Yeah, so I'm working on a couple different slide decks right now. Those are going to take some time because it's just me and I'm trying to do it right. I haven't recorded the audio or edited it yet, so I'm not done with the slide decks. Almost done. And then tomorrow I may do an oil show. There was some interesting data that came out from the Dallas Federal Reserve about a survey with shale oil companies, and it was covered in an oil price article. So a lot of the shale oil companies, it was anonymous, and they admitted that their costs are not what they're telling publicly. They admitted that their costs are quite a bit higher. So I'll talk about that maybe tomorrow or the next day. Okay, well, that's it for right now. Thank you very much to my over 200 Patreon account contributors. Hopefully it will be 300 by the end of 2020. My dozen or so monthly PayPal contributors, and people throw me a tip once in a while. It's much appreciated. Then I can focus on quality content, research, information, and analysis, just like today's show, which hopefully differentiates me compared to everyone else. So if there's any other breaking stories in the next week or two, I will be on it. Bye.